This is FRM Part 2, Book 2, Credit Risk Measurement and Management, and the chapter on credit decision. I think you'll like this chapter, mostly because it strays away from all the technical stuff that we've been doing recently. It's almost an entirely descriptive chapter, and it's based on lots of the relationships that we've talked about in previous chapters. The credit decision is really a description of the relationship between borrowers and lenders. And I think maybe the one challenge that you guys will have on an exam is to make sure that you can distinguish between the credit decision for individuals and the credit decision for businesses made by financial institutions. So let me just work through just a quick example here before we get into the slide deck. When an individual or a business goes into a bank and says, I'd like to borrow $50,000 for a car, or $400,000 for a house, or $10 million to expand my operations if this is a business, the banker asks the borrower the same question that I ask my children whenever they come to me and say, hey, Dad, can I have $10 or $20 or $30? I always say to them, what do I get out of it? And I'm really not asking for a financial reward. And so they know how to play the game. And so my children say, you know what, Dad, I'll give you a hug. How about if I give you a kiss? How about if I clean the kitchen? Or how about if I make all my foul shots in my basketball game or something like that? Well, the banker says the same thing. What do I get out of it? The banker looks at the borrowers, whether it's an individual or a business, and says, I want my money back and I want you to pay me some interest. Now, with that in mind, let's go ahead and look at these learning objectives. So notice we're doing lots of defining and explaining and comparing. We'll talk about credit risk. We'll talk about credit risk mitigants. We'll take a look at some techniques that are quantitative in nature and qualitative in nature. And then look at that one somewhere in the middle there, credit analysis of consumers, corporations, financial institutions, and some government entities. And then we'll end with just a little bit of mathematics, but not a lot. Let's go ahead and start really with the basics. The word credit has as its origin a Latin word that means to believe or to entrust. And so just think about this. When a borrower enters a contract to secure some capital and agrees to repay, essentially the financial institution or the lender is trusting the borrower to go and do with that capital what the borrower promises. Now, of course, it's a contractual agreement, right? Whenever we borrow money from a financial institution, whether we're a business or an individual, we have to sign a piece of paper. And on that piece of paper, it reads, I promise to pay interest and I promise to pay principal. And if I don't, then the bank has the right to come in and repossess the car or the house or maybe some equipment if it's a collateralized loan for a business. Now, of course, all borrowers are not created equally. Some borrowers have a great ability to repay and some less than a great ability to repay. And that's what credit risk is. Notice I'll go ahead and read that definition at the bottom. Probability that a borrower will not pay back a loan in accordance with the terms of the agreement. And I always tell my students that the interest rate charged to the borrowers ought to reflect that unique and specific credit risk for that unique and specific borrower. A lot of times it does, sometimes it doesn't. Now, for retail banks, credit risk is not avoidable because of the nature of banking, right? What does that balance sheet look like on a bank? They open their doors and the bank accepts deposits. So it owes the customers all of those liabilities, and then it lends that capital out to the borrowers, people who want to buy a house or buy a car or build a vacation home or pay for a seat on the space shuttle, whatever it is. And so during this process, every borrower has some level of credit risk. And this is how I always explain this to my students. I say, suppose that I come into the bank and I say, I want to borrow $100. So here's $100. And the bank says, well, how much money did you make last year, Jim? And I show them my tax returns, and I made $1 million last year. Well, how much credit risk is there associated with that? Probably zero, and probably I don't need to borrow $100 if I made $1 million last year. However, if just the opposite occurs, if I go in and say, hey, I want to borrow $1 million, and last year I only made $100, well, then that is a substantial change in the level of credit risk. Now, the important thing to know about financial institutions is that the credit risk that I pose the bank as that marginal customer or as that incremental customer is probably really, really tiny, right? The bank's balance sheet is this big, and I might borrow just this slice of it. So look at that in the middle block point, the second circle point. A single borrower is not big enough to threaten the operations of a bank. You know, there's a period there. Maybe that period shouldn't be placed in ink, but maybe placed in some pencil, so it could be erased. But in general, that's true. Now, of course, to manage this credit risk, you know, financial institutions have credit analyst models. And they use that to estimate default rates and then the losses associated with those. And of course, there are things called loan guarantees and collateral, which is, you know, by far the most common form of a risk mitigant. How about 4 components of credit risk evaluation? All right, so let's first look at the borrower's ability or capacity to repay the loan. So here I am, Jim, I'm a college professor. I make this amount of money a year, and so the bank will look at me and say, all right, Jim, you make this amount, and you're borrowing just this amount, so you ought to be able to repay that loan. But there's an extra element to this. Even though I might have the capacity and the ability to repay the loan, one day I may just wake up and say, you know what, I'm tired of paying the bank. I'm not going to pay it today. I'm not willing to pay that loan. So you got to combine capacity and willingness to repay the loan. And there are other factors that go on to willingness. Maybe I have some opportunity cost of making that payment this month, and I may want to invest it somewhere over here, and then maybe I'll swing back and make that payment at some date in the future. How about the second one? I have a colleague at school who's a really great professor, and he talks regularly to his classes about scanning the environment. He calls it an end scan. He's a supply chain dude, an operations dude, and so this is really important. I learned a lot in conversations from him. We need to make certain that we take a look at the business climate, right? What do we demand as financial institutions that we know that if the economy is expanding, we probably know that there are firms out there who are finding wealth increasing projects, which must mean sooner or later that there are more individuals working, and those individuals who are working are probably generating higher incomes. So it's extremely important to scan the economic environment. Now, notice there's a comma there. We really need to look at the political conditions, and this has changed dramatically, at least in my estimation. You know, I'm 58 years old. This has changed dramatically in the last 10 or 15 years, in which the politics are extremely important. And then, of course, operating conditions that are relevant to the lender. You know, suppose it's a business and they're a bakery and they make donuts. And, you've got the natural inclination of individuals who love donuts, right? Who doesn't like a chocolate donut? Well, I'll answer that question. One of my sons doesn't like donuts. But anyway, most people like to eat donuts, but most people know that if they eat 10 donuts a day, it's probably not going to result in a healthy lifestyle. And so a bakery has to balance, the taste versus the health awareness. How about characteristics of the credit instrument? When I borrowed money to buy a car, when I borrowed money to buy a house, I used collateral, right? So this was secured, and the banker holds the title to my car and holds the title to the house until I have made all of those payments, right? I've paid all the interest and I've paid all of the principal. Now that of course works for an individual, but for a business, suppose the business has a bank loan here, and then a bank loan there, and then a bank loan over there, 3 different financial institutions with 3 different terms. Maybe one has a 2-year maturity, and one has a 4-year, and one has a 6-year maturity. We need to figure out what is the priority. And so that's an important component of credit risk evaluation. And then the last block point there under characteristics is the currency of obligation. And this can become extremely important. We have talked in previous chapters about imports and exports and how those things affect the exchange rate and how that ultimately affects interest rates. And so part of this credit risk evaluation has to be a relative evaluation of the domestic economy and that foreign economy as well. And then lastly, let's look just briefly at the quality and adequacy of risk mitigants. I mean, the easiest risk mitigant for a financial institution is just to say, hey, Jim, let me have the title to your car, which of course the financial institutions demand. But there are also credit enhancements and kind of loan guarantees from other people. When I was younger and I first got my PhD and my wife we bought our first house, we had almost no money. And the bank dude looked at me and said, well, do you think you could get your parents to co-sign the loan? And I was like, wait a minute. I don't know, what was I? 28 years old at the time, 30 years old at the time. I thought, you know what? I really don't want to ask my daddy to help me borrow some money. So of course I did not. How about the difference between quantitative and qualitative credit risk evaluation? All right, qualitative, we know what that word means. It's a subjective judgment based on non-quantifiable information. And whenever I think about quantifiable information, I always think up here in my brain. I always think of human capital. So there's management expertise, management ideas, willingness and ability to show up for work early. All those kinds of things, including industry cycles and, probably the magnitude of research and development. And so the chapter gives you a brief discussion on these 6 C's of credit: character, capacity, capital, collateral, conditions, and control. And of course, these are qualitative measures, but, there's always some element of quantitativeness in there, especially when it comes to something like, maybe capital or collateral. But there's always the human element of there. Notice what I have in bold down at the bottom right there. Face-to-face meetings. It's always important to look across the desk from someone and say, all right, here's all this money. Can you pay me back? And you can look at the borrower and say something like, all right, I'm going to watch this person. Are their eyes shifting around? Are their nostrils flaring? What are they doing? When you watch TV shows, the detectives, they always say, I know when someone is lying to me. And so this, of course, is a skill set that bankers develop over the years. Now, quantitative credit risk analysis is much more down the path that I like to take. I'm a technical guy, I'm a math guy. And so, oh my gosh, look, balance sheet, income statement, cash flow statement. I love looking at those things so we can get a quantitative summary of the ability to pay. And that's what I was doing a little bit earlier, right? If I'm borrowing this amount and I make this amount, well, that sounds like a AAA rated bond to me. Inside of those financial statements, we're going to look at some particular areas, right? Liquidity, revenue streams. I mean, revenue streams are really important in addition to cash flow streams, receivables, existing assets, liabilities. Whenever I've been in the market for buying a house, and my wife and I have bought 3 houses during our 30 years of marriage. The financial institution is always interested in, do you have student loans? Let me see your credit cards. Do you have car loans? How many other houses do you have? Are you paying for somebody else under the terms of a contract? Now, here's a good point here at the bottom, a couple of limitations here. What we're doing is looking at the historical scope of those financial statements. Because remember, you do a financial statement like a balance sheet or an income statement, and you look at the history. And you can try to get as close as up to date as you possibly can in that history, but it's impossible to have those include yesterday's activities. And I've always been interested when my wife and I have had to provide our tax returns for things like, college loans and some other kinds of things for our children, where they'll say something like, 2 years ago, financial statements are okay and tax returns are okay. And I always scratch my head and think, boy, I could have made no dollars in the last 2 years, but yet 2 years ago, I could have made $1 billion and it would look like I'm in good financial situation. So that's a big limitation. And then the other part of that is these financial statements, they are not complete. They don't give you the entire story. And notice I have the word undoubtedly leave out certain pieces of information that might, they could be crucial in determining the borrower's ability to pay. All right, let's look at this from an individual perspective. Consumer credit analysis. The primary thing here is twofold. You look at the net worth of the borrower, which means you gather all of their assets, right? Their cars and their houses and their retirement assets and whatever kind of investments that they have. And then you look over on the other side of the balance sheet and you see the car loan and the mortgage loan and the personal loan and whatever other kinds of loans they have there. And we rely on that fundamental accounting equation, assets equals liabilities plus equity, to kind of back into that net worth. So net worth can be positive, which thankfully my net worth is positive now as a 50 or 58-year-old. But back when I was borrowing money for our first house, my net worth was negative, which is why the banker raised his eyebrow and flared his nostrils at me back during that process. I did get the loan for my first house, by the way. All right, so we look at the balance sheet, net worth, and then we look over at the income statement. But for an individual, we call it the cash flow stream. So we look at the income and we look at all that kind of stuff. Now, one of the interesting things here, and you guys should remember this conversation when we talked about correlation analysis and we talked about cupulas, these variables that determine the credit score of individuals are probably not unrelated. And what financial institutions have found is that there are some fairly limited number of variables that have relatively high correlation that are indications of the ability to repay. Look at that last circle point. I think that's important. Let me go ahead and read that. Extensive credit analysis often does not make economic sense, right? So, if I go into the bank and the banker looks at me and says, all right, Jim, you need a couple $100,000 to build a beach house. Is the banker going to spend a month figuring out whether or not I'm worth it? It probably doesn't make too much economic sense because what did I say, $4 or $5 or $200,000? That's probably a small amount. And the credit analyst can probably get away with taking a shortcut just by looking at my net worth and my cash flow stream. All right, let's switch over to businesses. What do we know? Boy, this is really important here, that the earnings stream from businesses are much more volatile. Take my example of the bakery just a few slides ago. When do people tend to eat donuts? I don't really know, but sometimes they eat a lot of donuts and sometimes they don't eat many donuts. And so you have volatility in that income or the earnings stream. And then that probably relates back to the asset and liability values, and they probably have much more volatility. So, of course, analyzing the credit conditions for a business is much more detailed. I have multiple students, probably multiple students every year, who graduate and then go work for financial institutions, and that's their first job as a credit analyst. And what they do is they simply pore over the financial statements of the businesses that come in to try to borrow money for wealth increasing projects or whatever it is. And so what do my former students do? They look at liquidity, they look at cash flows, They look at both the near term's earning capacity. And so this is a great thing, and I tell my students all the time that as a good credit analyst, as a good financial manager, you can separate yourself from the others by being able to more accurately predict what's going to happen in the future. And of course, in this intro position, these former students of mine, they're not trying to predict the baker's cash flows in 10 years, but maybe over the next 6 months or 9 months or 10 months, because this is what we know. When the borrower is able to pay early on, then they probably are more likely to pay later on. So near term's earnings capacity and profitability, and then solvency. And solvency is all about being able to meet short-term obligations. And so that falls under the heading of working capital management. And what I have found, of course, I have lots of friends in my area who run small businesses. And when they complain about working capital management. They complain about they're not collecting their cash quick enough, and they seem to have to pay their accounts payable more quickly than they would like to. And my question to them is always, do you have somebody there who's an expert in working capital? And inevitably they say, well, I do that myself. And so this is an extremely important part of analyzing business credit. Now, how about the credit analysis for a financial institution? All right, so this includes banks and non-bank financial institutions like insurance companies and investment funds. All right, so what's important? We're still going to look at liquidity and solvency and earnings and all that kind of stuff. State of the economy, so we got to do an environmental scan, industry, environment factors. My college had an economics professor in to interview this person as an economics professor. And he gave us a really, really good lesson on industry and environmental factors. And so clearly this is really important here. But we need to also be aware that asset quality, and I tell my students this all the time, quality of the asset, it doesn't really mean like what's a ratio of one asset to another or one asset over there to the liability. Asset quality, think about this in the following terms: the ability of that asset to generate profitability, not just tomorrow, but next month and next week. And so the focus is on asset quality, right? What is the asset quality? What is the performance of those loans? What is the performance? What is the ability of those loans to turn themselves into cash in the future? Keeping in mind that in this part of the credit analysis, cash flows are omitted. And look at the bottom blue box I have down there, and that's an important sentence. Let me go ahead and read it. An institution's earnings capacity over time is a more relevant indicator of credit worthiness than cash flow. And that's true for financial institutions. How about if a government shows up at the financial institution's door and says, "Hey, I'd like to borrow some money." So we have municipalities that want to borrow money, and we have federal agencies and federal governments who want to borrow money. And whoops, I didn't mean to hit that. And so, the credit worthiness of a state, let's say, has implications for the credit worthiness of those non-state entities operating in specific jurisdictions. So everything applies, what we've discussed before. But now we need to look at the specific economy inside of that municipality or province or whatever that sovereign entity is. Now, I said to you earlier that we're going to do just a little tiny math, so that's probably what we're going to do here in the next couple of slides. All right, so we have the starting point. Probability of default measures the likelihood that the borrower will default on the terms of the contract. All right, and this is always expressed as a percentage. 50%, right? If I come into the bank and I want to borrow this much and I only have this much in income and assets, my default probability might be 50%, right? And so the couple of things to consider here is that, I may have a 5-year loan and I may default on, let's say, a September payment and maybe an October payment, but then something good might happen to me and I may be able to come back and repay those with with interest on top of the interest and top of the principal, and maybe some kind of missed payment charge. And so I can go from being in default to being current in a relatively short time. And so this is another challenge that financial institutions face. So look at that last circle point. Non-payment for a limited period of time can cause the lender some financial strain, but the tangible harm would be negligible. Now, how about this concept, the loss given default? This is the percentage loss if indeed the borrower defaults. And this is also expressed as a percentage. Now, the probability of default is important. So let's go back to my example. What did I say? I borrow $100 and I have a 50% chance of default. That doesn't sound like a very good scenario for a financial institution. But suppose a business comes in and borrows $5 million and has a 1% chance of default. Well, if you just compare me, right, 50% versus 1%, you think I'm the higher credit risk. But if you take 50% of 100, you get a number, and if you take 1% of 5 million, you get another number, right? And those two numbers they're not very close together. So the severity of a default is equally as important, if not more important, especially in my example. And then the exposure at default is the value the creditor is exposed to when that default event occurs. And this is almost always, I mean, as I've seen it, it's almost always given and expressed as a dollar amount, but it can be expressed as a percentage of that original amount. And so there's our expected loss formula. Notice the scroll I have down the bottom right. Important formula used in many, many chapters throughout the program. So the expected loss is really the product of those three variables that we just described. And so the mathematics it's a relatively simple calculation. Just remember that the first two are in percentage terms, and then the third one will probably be an amount. Now, one of those learning objectives asks us for about the timeline. So let's ask the question, what happens to the expected loss during longer maturity dates for a bond? So probability of default. So of course, for longer terms, this is going to increase. The loss given default really depends on the specific terms and the structure of the loan. And then if you go back to this exposure at default, I mean, you think about it. If I owe the bank $100 and I'm paying $10 every month, part of that $10 is interest and part of that is principal if this is an amortizing loan. So I'm reducing the balance that I owe the financial institution. And so that exposure at default probably increases as more funds are dispersed, but then it decreases as it is gradually repaid. And so, if you look at this, here, let me go back here real quickly. If you look at this expected loss, in the aggregate sense, then this slide makes really good sense. This is a guaranteed exam question on many of my exams. I always ask students to tell me the difference between insolvency and bankruptcy or a bank failure. And it applies here. Insolvency is really just simply the inability of a bank to pay its debts, right? Think of the top portion of the balance sheet. Current assets over here, current liabilities over here. How can the bank turn its current assets into cash to meet those payments? And what we see is that, there historically lots of banks are insolvent. In fact, banks are probably insolvent way more than we even know about it. But do we really care if the bank has to wait until tomorrow to make one of its accounts payables? I mean, maybe we do, but maybe we don't. I mean, it really depends on the history of that financial institution and its long-term strength. All right, so two ways here. Let's look at this. So what did I say? Liabilities exceeds its assets, and if it has these severe liquidity issues. Now, bank failure, on the other hand, is a dramatic event. This is the closing of a bank. So think about what that means. That the bottom right portion of the bank's balance sheet, the equity portion, has to close up and shrink down to zero before you can close a bank. And this is what we know, and I'll show you this in the next couple of slides. But what we know is that most banks don't fail because either A, the government comes and takes them over, or B, another financial institution comes and takes them over, or C, what we saw in the 2007 to 2009 financial crisis, the government comes in and asks a bigger bank to take over a smaller bank. Yeah, look at that first block point there. Banks regularly run into solvency issues, but very few of them fail. Look at the bold that I have in the circle point. Regulators and governments do everything possible to prevent this from happening. And that's why we have these too big to fail banks that are considered systematically important banks. Notice I have mergers and acquisitions in bolded there. And I think here are some statistics here. Only 50 banks failed between 2001 and 2008. Half of which occurred in 2008. And so look at those percentages, 0.1, 2%, 1.2%. So, so those are pretty compelling statistics that show that the focus ought to be on insolvency rather than failure. And I think that takes us through all those learning objectives.